Morning, everybody, and welcome to the meeting. This includes all members of the public here today. The meeting is being broadcast live via YouTube, and the recording will be made available on YouTube in due course. Members will be familiar, for those not attending in purpose, and will be familiar with Teams, MS Teams. Unless speaking, can all attendees please, joining virtually, please make their microphones mute or reduce this will reduce the background noise. Committee members attending virtually can keep their cameras on, but any non-members attending virtually should turn off their cameras unless speaking. Please only speak when invited to do so by the chair, and if attending virtually, remute your microphone once you've finished speaking. If any members joining virtually would like to ask a question or make any comments, please use the raise your hand facility within MS Teams. Just be aware that the Local Government Central Joint Committee trained union representative has stood down. A process for replacement is on the agenda for today's meeting. This means there'll be no trade union representative for today's joint committee. So if I could invite members present today, the councillors and LGPS Central attending, and the acting clerk to introduce themselves. If we can start over here with Bulesh.
Thank you, Chair. I'm Bulesh Katra, representing the Leicestershire County Council Pension Fund. Tom Biggins, Chair of the Shropshire County Pension Fund.
Justin Bridges, Head of Pensions at Shropshire County Pension Fund.
Tamsin Rabbits from the Nottinghamshire Pension Fund.
Neil Smith, Derbyshire Pension Fund.
Yeah, and just on the second row, starting from the right, moving to the left.
Sharif Lutfi, Head of Pensions Investments at Worcestershire Pension Fund.
Elizabeth Eyre, Chairman of the Worcestershire Pension Fund.
Morning, Tim Byford, Staffordshire County Council.
Morning, Stuart Bearn, LGPS Central.
John, if you could introduce yourself.
John Burns, LGPS Central.
Anushka Ramsey, LGPS Central.
Starting on the front row from the left, if we can move along there.
Richard Lawdeeks, I'm the CEO of LGPS Central.
Cara Forrest, I'm Head of Clients at LGPS Central.
Patrick O'Hara, Head of Responsible Investment, LGPS Central.
Trevor Castledine, Chief Commercial Officer, LGPS Central.
Thank you.
Nadeem Hussain, Head of Private Markets at LGPS Central.
Mark Davies, Head of Public Markets at LGPS Central.
Lovely. Thanks very much. There have been no new members appointed to the Joint Committee since the last meeting. So if you do want to speak, it's a fairly obvious microphone system. Just put your hand up and I'll call you to speak and press the speak button on there. We've received apologies from Councillor Mackinder Jaspel of West Midlands Pension Fund, Councillor Mike Southerington of Staffordshire Pension Fund, and Councillor Miles Hogg of Cheshire Pension Fund. And this morning we've received apologies from Councillor Kerry, who has got unfortunately unwell, and he's only contacted us this morning. That means that the meeting isn't quorate. So agenda item 8, we will have a show of hands. We won't make a decision, and we will contact afterwards to get a decision on that. But the rest of the meeting will carry ahead. The next item on the agenda is declaration of interests. We would normally expect the trade union representative to declare an interest in their union as an outside body. However, we have no representative here. And at the moment, I'm not expecting any other declarations of interest. Has anybody got any declarations of interest? No, fine. So the next item is the minutes of the meeting of the last committee are here for approval. They're on the agenda. There were no actions arising from the minutes. Are they agreed? Is everybody happy to agree them? Yeah. Okay, that's unanimous. Item 5, public questions. There have been 4 questions from members of the public. The questions have been published in the supplementary report pack available online alongside the main agenda and reports pack. The responses have not yet been published, but they will be. So I will read out the questions and then we will get the answers advised. So the first question is received on the 27th of August 2024 from Mr. P. Hollett. Is it possible to avoid investing in armaments and fossil fuels, as both have a deleterious effect and still get reasonable, as both have an effect and still get, so in other words, can we avoid investing in armaments and fossils and still get a reasonable yield? So over to you for the answer.
Thank you, Chair. So on behalf of the committee, the answers. LGPS Central Limited, LGPSC, takes an approach to responsible investing, RI, which relies on the integration of material, environmental, social and governance, ESG, factors into investment decisions, making and on engagement with companies to encourage better standards of corporate behaviour. LGPSC does not make investment decisions based on moral or ethical considerations. LGPSC expects the companies in which we invest to abide by international law and global norms. LGPSC does not consider sector-level exclusions to be the most effective way for investors to achieve attractive, risk-adjusted returns over long-term investment horizons. Nor do LGPSC consider it to be the most effective way for responsible long-term investors to influence corporate behaviour, investment markets and critical ESG issues such as the climate transition.
Thanks very much. The next question received on the 28th of August from Ms. C. Moley. What action is being taken to divest pension funds from all fossil fuel and biofuel industries to ensure we meet the net zero targets? I'm extremely concerned that my pension stability relies on fossil fuel investment and profits because I do not want to benefit from trashing my grandchildren's future. So
LGPSC's strategy is predicated on active ownership rather than divestment. Remaining invested in the fossil fuel sector allows investors to engage, using their influence as shareholders to advocate for stronger climate action. Divestment may change the carbon footprint of an investment portfolio, but it does not reduce real-world emissions, which is essential for the achievement of net zero. However, it is likely to bring about the transfer of shares to investment institutions less concerned about climate change and less inclined to engage with corporate leaders on this critical issue. A complicated and multifaceted global transition affecting both the demand and supply of fossil fuels will require responsible long-term corporate ownership. LGPSC supports an orderly and just transition to a decarbonised economy, focusing on ensuring that fossil fuels are produced as responsibly as possible, while supporting investment in the transition and the development of overarching climate policy through engagement with companies on responsible lobbying practices and advocating for positive climate policy with governments and regulators. LGPSC engages with companies such as Shell, BP and Glencore, who are critical to the transition and the achievement of net zero ambitions. LGPSC ensures that engagement asks are realistic and aligned with long-term value creation. LGPSC utilises our escalation framework to escalate concerns when an engagement is not progressing in line with expectations. This includes voting against management recommendations on resolutions at AGMs where our expectations are not met, raising a topic directly with the company at their AGM, and filing a shareholder resolution. LGPSC expressed concerns in the press about BP's revised climate targets. LGPSC wrote to Shell outlining the rationale for voting against their 2024 energy transition strategy and have arranged to meet the chair to discuss the strategy in further detail. LGPSC withdrew a shareholder resolution at Barclays following positive engagement with the company, resulting in a commitment to stop financing new oil and gas fields and restrict lending more broadly to energy companies expanding fossil fuel production. LGPSC will meet with the CEO of Barclays in October to gain reassurance that the company is following through on its commitments. The LGPS is a statutory public service pension scheme, so the scheme's benefits and terms are set out in regulations passed through Parliament. The LGPS is a defined benefit pension scheme, which means the pension members get what the pension members get is based on how long they've been a member of the scheme and how much they earn, and will not be directly affected by stock market changes or performance of investments.
Thank you. So the third question received on the 4th of September 2024 from Mr. D. Plunkett. The webpage ACS Subfund Investment News LGPS Central lists all funds that LGPS Central manage for March 2024. Full details of investments on page 2 to 34 show that LGPS Central Climate Fund continues investments in fossil fuel companies of nearly 100 million, including BHP, Rio Tinto, Petrotech, Brasileiro, Petronet, Tokyo Gas, Qatar Fuel, Repsol, Iberola, Shell, ExxonMobil, Chevron, and ConocoPhillips, and others. Have any of the 8 council funds that own LGPS Central questioned these investments or declined to invest in the Climate Fund because it contains contradictory fossil fuel holdings?
LGPS Central Limited engages with its investors on the climate metrics of each fund. These are considered as part of the initial investment decision and as part of ongoing due diligence. Each fund will consider and authorise investment decisions in line with their own stated investment beliefs. Climate metrics are then subject to ongoing reporting through the life of each fund.
And the final question was received on the 8th of September 2024 from Mr. D. Chowan. LGPS Central invests in a number of tobacco companies such as BAT, Imperial, and Japan Tobacco. Deaths, cancer, and illness are caused by tobacco have a major impact on the NHS, and there are additional concerns that companies are targeting vaping as an increasing alternative attraction to young people. For over 50 years, smoking and tobacco have been identified as one of the most preventable causes of damage to the lives and families of the population, not only in the UK, but globally. How do LGPS Central reconcile these investments with the ESG and responsible investment statements?
LGPSC pursues a strategy of incorporating ESG factors into investment decisions, as we believe this strategy is best aligned with our fiduciary responsibilities. It requires a holistic and long-term approach to investment management. LGPSC expects the companies in which we invest to abide by international law and global norms. However, LGPSC does not make investment decisions driven by moral or ethical considerations. LGPSC considers that an investment strategy based on exclusions or divestment is not the most effective way to achieve attractive risk-adjusted returns for our partner funds.
Okay, thank you. So we now move on to item 6, which is the Practitioners Advisory Forum update, which is an update on the work of the PAF and its working groups. Bulash Karcher from Leicestershire to present as the current chair of the Practitioners Advisory Forum. So over to you, please, Bulash.
Thank you, Chair. Good morning, everyone. The purpose of the report is to update the Joint Committee on the work of the Practitioners Advisory Forum, or PAF, and its constituent working groups. A bit of background at point 3 in the paper. PAF is the senior officer working group that supports the delivery of the objectives of the pool and to provide support for the pool's joint committee and shareholders forum. Our colleagues from Central also attend part of every PAF meeting. PAF has 3 working groups which support decision making. These are listed in the paper there. So that's the Finance Working Group, FWG, the Governance Working Group, GWG, and the Investment Working Group, IWG, which also incorporates the quarterly responsible investment focus meeting. So every third meeting, there's a fair amount of responsible investment agenda within that one meeting. Each working group produces a report which updates PAF, and each of those reports is presented by the chair of that working group. The partner funds have also established an internal audit working group to enable the joint committee, the individual partner funds, and the respective external auditors to be satisfied on the standards of control operating across the board. At point 4, we've got the main activity completed since the last joint committee, which would have been in February. There are 10 items listed there. I won't read them all, but I can summarise a few of those. Over the page, on page 16 of 17, we've got the MHCLG cost savings return. So this is an annual return. It notes in the paper here it's well underway, submission due shortly. It has now been submitted. Another point on there, fund launches. IWG has continued its work with the company on the launch of new products. You've got a table within that section there. So there's 4 products, an indirect property fund, an investment grade credit fund, private credit vintages for 2024, and a buy and maintain credit fund. Investment performance. IWG scrutinises the investment performance of all the company's funds on a quarterly basis to seek the understanding of the reasons for both under and outperformance against targets and benchmarks. IWG has worked with the company to develop the investment performance meetings to make them more focused and effective. Moving on to point 4.2 of the paper. In the coming months, PAF's activity is expected to include, we've got a number of bullet points there, but just to summarise quickly, engagement with the company on the business plan and budget for 25-26, and that's in line with previous years. Consideration of a revised cost-sharing model following review by FWG, that's the Finance Working Group, and collaboration with the company to further develop the pool's responsible investment outcomes and climate stewardship commitments. I think that's all we've got at the moment, but happy to take any questions.
Thank you, Rush. Has any member got any questions or queries on the paper as presented? It looks as though we haven't got any questions or query. So we'll move on to the next update, which is item 7, LGPS Central Risk and Assurance Update. As you see in the paper, it's a high-level summary of the pool risk register, which has been produced in conjunction with the partner funds and the company, and a summary of recent internal audit work has been undertaken. We have with us this morning Sheriff Luthley, as current chair of the Governance Working Group, who's going to present to us. So over to you, Sheriff.
Thank you, Chair. Good morning, everybody. So the purpose of this paper is to give committee a brief update on the pool risk register and also on the an update on the insurance activities. So just before I get into the pool register, Chair, I'd like to just give some enlightenment on the background. So the risk register is a collaboration. It's produced in conjunction with both the Partner Advisory Forum and LGPSC in conjunction together, working with one another in collaboration. It's important to note that the risks identified in the risk register are one of that they concern the central investment pool rather than the company itself or the individual partner funds themselves. The updated risk register is attached to Appendix 1, Chair, for everybody to see, and just as a reminder, this represents a forward-looking review of the potential impacts on the pool's operations. Whilst this risk register is updated each quarter, it is important to note that the direction of the arrows on the risk register are not an indication of a quarter-to-quarter movement. They are an indication of how the initial assessed risk has moved after mitigation has been put into place. So just moving on briefly, I don't intend to take you through the entire risk register there, but I'll just touch on a few items. The first being the regulatory and political environment. Now, this covers potential changes in pension policy, particularly pertinent at the moment, Chair, given that we've had a change in government. And whereas the previous government had focused on pooling and asset transition, the current government appear to be shifting their focus towards consolidation and supporting UK growth. So as you'll see there, it's obviously quite a pertinent risk that's been identified there. And the reason why we have a horizontal movement in the arrows there is because we are largely in reactive mode here, waiting to see what central government decide to do in their pension review. Also wanted to touch, Chair, on the resources issue, the first item there on the risk register. This continues to be a prominent factor within the risk register, and it's both within the LGPS environment and also the wider pension investments industry. It is vitally important, given the nature of the work, that that the industry and the LGPS framework maintain a degree of expertise within this field. I think you can see there that the arrow is positively pointing downwards, which means that is an indication of the fact that the pool itself is constantly considering these risks and is taking action to mitigate these risks through, for example, HR strategies to ensure that relevant expertise is maintained within the pool itself. And the final one I wanted to touch base on in the risk register is the market volatility. So this is particularly pertinent at the moment, Chair, as pension funds head towards another review of their investment strategies and heading towards another triennial valuation. It's important to consider the impact of market volatility and the macroeconomic factors which prevail. I think it's important to note here that partner funds continue to work with the company to assess the funding requirements and therefore product development as appropriate. So that's all I wanted to touch on in terms of the risk register. What I'd like to do now, Chair, is to give you an update on the assurance work that has been conducted. Again, as a bit of background here, the internal audit working group consists of audit representatives from all 8 partner funds, and their aim is to support the pool and partner funds to develop a collaborated internal audit framework. Their key tasks, Chair, are to develop the assurance framework to ensure that it is aligned to the risk register that we've just looked at, and also to review the annual audit assurance reports that provide comfort to partner funds and the pool in general as to systems and controls that are in place. Just like to give an example here, Chair, that during 2024, a key piece of work that the internal audit working group were involved in was the liaison with partner funds and the company and external auditors of those partner funds in relation to the control reports for 2023-2024. And another aim they have is to complete a programme of internal audits concerning governance and investment processes. So what I'd like to do now is just give you a very high-level summary of some of the work that those internal audits have involved. So during 2023-2024, there were 2 main audits. The first one being concerning pool governance arrangements. Now, this audit was completed by Wolverhampton City Council, and the result there was a satisfactory outcome. So generally, they found that there was a sound governance system and risk management control. So that was pleasing to see that. The second internal audit, was completed by Staffordshire County Council, and this focused on investments, and more specifically, it focused on the manager selection and monitoring of those managers. I'm pleased to say that this resulted in a substantial assurance rating, which indicated that the internal controls were in place and operating as expected. And just briefly before I finish, Chair, I just wanted to point out that the reports that the Internal Audit Working Group produce are presented to the Partners Assurance Forum for approval. So the approval of the governance audit was achieved in May 2024, and we're expecting any time very soon to approve the more recent investment audit before the end of 2024. So happy to take any questions on that, Chair. Thank you.
Thanks very much for a full update. It's good to see that 7 out of the 8 sort of risk areas you identified are actually moving in the right direction. The other ones level, and no doubt you're still working on that. Has any member got any queries or questions after that report? No? Okay, so we'll move on to item 8, which is appointment of the Joint Committee Trade Union representative, which we won't be, we will hear the paper. The reason why we're having this is due to the current trade union representative standing down. An appointments policy and role description has been drafted, which is presented today. We won't be able to approve it, but we will have a show of hands from members present to see whether they would endorse it where we call it. So over to Chris Buzak, who is the acting clerk to the Joint Committee, to present.
Thank you, Chair. So the reason, as you explained, why we are putting in place a policy here is that since the Joint Committee's inception in 2017, there's been one representative, a trade union representative who sat on West Midlands Pension Fund's pension committee and has got an extensive pensions experience. He's no longer a member of the pension committee in West Midlands, and so has stepped down from the role at the Joint Committee. There's been no policy or procedure in place to date. So in order to appoint a new representative for the trade union, which is required under the recently agreed terms of reference of the Joint Committee, it's necessary to put a policy and a role description in place. So this has been discussed at the Pensions Advisory Forum, and the policy put place, if I sort of run through at a very high level. The intention is that the trade union representative will be selected from the partner funds pension committee or local pension board. They'll be appointed for a term of 2 years, and then the process will be repeated, looking to have a different representative from a different partner fund or a different trade union body to make sure there's a fair representation. So the process will be to invite nominations from the partner funds, pension committees or local pension boards. The clerk to the Joint Committee and the chair of the PAF will go through those initial applications and put forward recommendations to the Joint Committee's chair and vice chair. They can then review those and decide if it would be appropriate to appoint somebody or whether it be appropriate to carry out any interviews. If it's deemed appropriate to carry out interviews, then an appointments panel will be put together, which comprised the chair and vice chair of the Joint Committee and also the clerk and the chair of PAF together. If no appointments are made, no one's deemed suitable, then further approaches could be made to the trade union bodies direct to see if there are any appropriate nominations, and the process will be repeated. If within the 2 years a member steps down from their role on the pension fund committee or local pension board, then they will vacate that position and the process will be repeated at that stage. The role description appended briefly explains this for members. I'm happy to take any questions on that, Chair.
Thank you. Thank you, Chris. So have any members got any questions they'd like to raise on the process for appointing a TUC? No. Okay. So just for those members who are present, this isn't an approval vote, but can we just have a show of hands to show whether you would approve that? Okay, so everybody here today who is a committee member approves that policy. So we will, after the meeting, contact others who aren't present and get formal endorsement of it. So thank you. So the next item is the LGPS Central update. We have with us, they introduced themselves earlier, we have the Chief Executive Richard Law-Deeks, John Burns, Deputy Chief Executive, Trevor Castledine, Chief Commercial Officer, Mark Davies, Head of Public Markets, Struan Fairbairn, Chief Legal Officer, Cara Forrest, Head of Clients, Nadeem Hussain, Head of Private Markets, Richard Law-Deeks, who is the Chief Executive, Patrick O'Hara, Director of Responsible Investment, and Anushka Ramsey, Chief People Officer. So welcome to you. I'm going to hand over to Richard now to continue the presentation. You will see the slides are actually on the agenda, so you can follow them through. So Richard, over to you, please.
Thank you, Chair, and good morning, everyone. It's really nice to be back in Leicester. The first pensions committee I attended as CEO was back here in June, so it feels a bit full circle to be here back for my first joint committee. We've left the placemat on your desks. This provides an overview of where we are today, all on a single page. I'm not going to talk to this specifically, but hopefully it's helpful as a refresher of the journey so far and recent headlines. I want to take this opportunity to set the scene a little bit before my colleagues go into some of the details. At the recent AGM, I spoke about my first 100 days and what a pivotal time this is for LGPS Central. The pensions review that was launched in July is a key part of this. In phase 1 of this review, the LGPS is very much in the spotlight. The government has outlined 2 key objectives, which I'll paraphrase. 1, increase investment in UK productive finance, and 2, achieve better outcomes for pension scheme members. Things are moving really fast, and we've already responded to a call for evidence which closed on the 25th of September. Just last week, representatives from the Ministry of Housing, Communities and Local Government and the Treasury visited Wolverhampton to meet with our partner funds. We're expecting an interim report sometime after the budget, but before the end of the year. And with that, I'll hand over to Cara.
Richard, so I'm going to jump ahead in the slides to slide 6. Amy, slide 7, and just wanted to give you a quick recap of where pooling has got to for all of our partner funds. So this slide sets out the progress of pooling to date for everyone as at 31 March 2024. And as you can see, we've got around 44% under pool management as a collective. And if we allow for the joint procurements that have taken place before pooling, that number looks up to 67. And as Richard said, this really is a pivotal moment in pooling. And to date, and Trevor will touch on this in a moment, we've really worked together on making sure we've got the right building blocks in place for our partner funds to be able to pool their assets. And if we move on to slide 8, we can see what that progress is going to hopefully look like over the next few years. So that kind of 44% where we are now is really going to grow. And by 2028, only around 20% of assets are going to hopefully be outside of the pool. And that largely relates to legacy stuff that's got high transition costs or is locked up for several years in private markets. So this really is a turning point for us. We've done the hard work to get where we are, and hopefully we'll be able to bear the fruits of that labour in the coming years. That's just a quick update on where we are now, and I'll hand over to Trevor.
Thanks, Cara. And if we could move 2 more slides forwards. So I just wanted to outline, perhaps as Cara's indicated, this may be a slight turning point for us in terms of where we've got to and how LGPS Central, together with partner funds, moves forward. And a couple of things that we've done, one of which is to look at the allocations that LGPS makes. And this is not LGPS Central funds, but this is LGPS across the country. This is data that's put together by the Scheme Advisory Board, where they collate all of the submissions and all of the accounts from across the LGPS in the UK. And we see that, firstly, 2 messages here is that there are probably about 12 or 13 underlying asset classes that people, the Scheme Advisory Board group things into. And secondly, that there's really not much change year on year. And I'm sure that we could go back over the years and find this to be the case. That really there is a stable set of allocations across the LGPS. And I think this comes back to the fact that whilst all LGPS are different, they all have their own local nuances, but they also broadly are providing a similar set of benefits, or the same set of benefits to a very similar demographic of people. And so they tend to choose with variation from a similar set of assets. So the question we need to look at going forward is how our partner funds compare to this national picture, and really whether LGPS Central needs to produce more funds that in order to complete the pooling journey, or whether our current building blocks are sufficient. And I suppose then the second thing, if we move on to the next slide. So the second thing that we have looked at is, and this is just the LGPS Central partner funds. We've looked at the ways they or their investment consultants describe asset allocation. And this word cloud is words that are actually used in terms of the descriptions of strategic asset allocation from within our group of partner funds. And you'll see that there are lots of different descriptions being used. And yet, when we boil it down, we find that these different descriptions are really sort of mapped to a much smaller group of underlying requirements. And so what we need to do going forward, as well as making sure that our product suite is complete, is to make sure that we try to work together with partner funds to align the way that with partner funds cooperation, to try to align the way that these strategic asset allocations are described, because that will help us to drive the next stage of efficiencies, I think, because we run at the moment, and if we move on to the next stage, we'll see the journey we've been on. Amy, can we go on to the next page? Apparently not. It's coming. The next here. So this next page. So looking backwards, you'll see the journey we've been on. And ultimately we've raised, we've raised 27 funds and closed one. So we're running 26 funds. We've seen slowly but surely we've built out from the areas where there was most common ground. So passive equity funds, global equity funds, working forwards to some of the more commonly held private market assets. Obviously things slowed down a little bit during 2020 for reasons that everyone would understand, but we caught up very rapidly in 2021, launching a variety of funds. So really we have, by the end of 2021, I think we probably covered most of partner fund requirements. And then moving forward 22, 23, and this year, we're filling in the gaps around the edges. But I think we have a good product suite, and we've made enormous, and I think we should celebrate the fact that we made enormous progress in terms of the product suite we have. And so two messages from that is one is we've got a very complete product suite. The second is that we have a variety of differing requirements from partner funds, and what we need to do is to try to work together to align those requirements to drive further efficiency moving forward. That's not to say that there aren't some funds left to complete, and if we move on to the next page, we'll look at things that we are talking about. Now, some of these, moving from left to right, these go from perhaps more solid things that we know we're going to deliver, things like private credit, where this says launch expected in Q3 2024. Actually, the first vintages are launched now. Sorry, not the first vintages. The first closes are launched now. We've got commitments from a number of partner funds, and so that's making progress. We have a buy and maintain credit fund, which is expected to launch. I don't think that's November, I think, is the target date for launching that. We have strong support from within the partner funds for a global investment grade credit product, which we expect to launch hopefully before the end of this financial year. We're always open for infrastructure. We're investigating an overseas property sleeve. We manage UK property opportunities. And then there are some other things in discussion. And the question is whether these reach the scale and the number of partner funds that want to do it. Things like smaller companies, smaller listed companies, things like natural capital, and things like local investment. So we continue to work on these pieces, but I think at that point we will have a pretty complete set of offerings. And as Cara said earlier, the things that remain unpooled are likely to be asset classes where they're either illiquid or there are significant tax costs, like things like legacy property portfolios, where we'll have to put our imagination to work to pool those, or they'll remain unpooled for a little bit longer. So if we just go back to summarize that on the next page, what do we really need to do? I think we need to continue to improve our partner funds' confidence in our ability to deliver investment returns. We've got some of our funds, in fact, some of our longest standing equity funds are, really very strong performers when you compare them against the competitors in the market. But we need to continue to talk and communicate with our partner funds to make sure that the confidence in our investment delivery capabilities is there. One of the things we're also doing as a request to partner fund requests is investigating whether third-party oversight or specialist expertise can help us on that journey of increasing confidence and delivering reliable, resilient returns. And then this final point, identify additional solutions. So are there ways that we can look at asset classes that so far have proved difficult to pull? Are there new solutions we can bring to the table? And can we make sure that the product set that we're offering is actually doing the two things that's necessary? One is meeting partner funds' needs, but the other is meeting those needs efficiently. And that's where we need to move forward over the coming period. With that, I'll hand over to Mark to cover investment performance.
Thanks, Trevor. Good morning, everyone. It's my pleasure to take you through some high-level active or public market performance to begin with. Then I'll hand over to Nadine to take you through private. If you'd just like to turn to slide 16, please, Amy. Here we've pulled out 5 of the active funds. We've got to give you some highlights over the past year. Starting on the left, the Global Equity Fund, as Trevor mentioned, continues to have first quartile performance since inception. This is great news, considering the backdrop of the last 12 months, where the fund has been underweight in the Magnificent Seven that have driven equity markets to new highs, and yet the fund has continued to keep pace with those markets whilst being underweight in those positions. So we're a fund that we are incredibly proud of as a business. The Multi-Asset Credit Fund. Now, this fund has invested in bond-like instruments, but it's measured against a cash benchmark. So as those bond yields rose, the fund did actually lag performance. As that interest rate cycle has started to turn, we are starting to see the performance come back in the multi-asset credit space, but the managers are still slightly below their peers, which we'll come on to on another slide. Now, sustainable equities, it's a slightly different solution that we offer here. It's made up of 3 separate funds, each with a single manager in. So no one partner fund has the same allocations, unlike the Global Equity Fund where we do those allocations. Here in the sustainable space, 1 fund is performing well and 2 are lagging at the benchmark. Now, to give you some background, sustainable equities tend to have style biases. They tend to be quality growth funds, and they are measured against kind of like the full benchmark or index. So there's stocks that can perform well in the index that these investors wouldn't touch, for example, energy companies. We wouldn't expect to see any energy investments in the sustainable equity funds. However, they are measured against those types of companies. So we would expect there to be periods of underperformance, and 2 of those funds are currently going through that whilst their style of investment is out of fashion at the moment. But we're very still strongly supportive of those managers. It's just the style biases or the headwind that they're facing. The Emerging Market Bond Fund has really strong performance, is outperforming its benchmark and its target objective. But however, the Emerging Market Equity Fund has continued to lag, but the team is working hard to make improvements there that should see that performance turn around. And in fact, the positioning that the managers have taken around China has started to recover over the last couple of months. So we're seeing some positive performance movements there. Moving on to the next slide, please, Amy. Here you can see all the ACS performance. The first box at the top is all the passive teams, passive funds performance. You can see the column that states yes, that they're all within their tracking range, to highlight that the passive funds are doing exactly as they're expected to do. Just to give you an idea of quantum, there's £7.6 billion within those strategies, all doing as expected. On the active side, the lower half of the table, just to bring to your attention those numbers, the ones where they are positive, that is where they are beating their benchmark over various timeframes. Here in the active space, we have 9.3 billion in AUM. And to give you some sort of background, over the entire nearly 17 billion AUM, there is 14% is actually below its benchmark. So 86% is either doing as it is expected to do, i.e. the passive funds, or beating their benchmarks since inception. So they're the funds. If we move on to the next slide, this is how our funds stack up against their universe, or the managers or the opportunities out there. Ones to highlight or to draw to your attention, you're looking for the 1s or 2s over different time, ideally consistently over all of the time frames. So the Global Equity Fund again, and our largest bond fund is also 1 or 2 quartiles over those time frames where they have that history. So again, two funds we're extremely proud of. Ones where they're slightly weaker, well, we've shown and talked about the sustainable funds. We've actually presented these against the ESG universe of managers, so you can see how good our managers are against their peers. Again, longer term track records in those areas for those ESG managers, focus managers is strong, but in shorter time, a couple of them are struggling. So work to be looked at there. And again, we are just to highlight the Emerging Market Fund, as we've said, is a struggle. It is a struggle over the longer term, and it's something the team at Central is working hard to change. I'm happy to take any questions.
Has any members got any questions on that presentation? No?
Thank you, Chair.
Obviously done a good job.
Thank you, Chair. So I'll briefly go through the performance of the private markets funds. As you'll see on page 19, 7 of the private market funds are within their qualifying period, and the remainder are not within their investment qualifying period. Of those 7, 3 we're pleased to say are performing ahead of target and ahead of benchmark, that being the sort of private equity co-investments fund, one of the credit partnerships, Credit Partnership 2, which is our direct lending fund, and our single asset infrastructure partnership, which are all performing ahead of target. One of the funds in private equity, which is the first one that you see on that table, is the 2018 vintage. That's performing ahead of benchmark but slightly behind target, although capital, as you know, has been deployed in that fund, and we'll start seeing that return come through as the private equity market continues to gain traction and companies start selling and we start getting distributions back. It's important to know, as Trevor mentioned at the beginning of his session, that actually in private markets we'll start seeing that performance over time, as opposed to straight away, unlike in private markets. In the second half of the table, that gives you a brief overview of our funds which are not within their investment qualifying period. And as a result of capital being drawn over time and smaller numbers, and the fact that performance is likely to be volatile over the period, we're likely to see numbers sort of be up or down over the investment period. Now, some of those funds, such as the infrastructure funds, the investment period kicks in 5 years after the inception. So, for example, in the Core Plus fund and the Value Add fund, 5 years after June 21 and April 21, respectively, is when that investment period starts to kick in. But so far, there's no in terms of the capital being drawn, there's no concerns for any of the underlying funds or any of the underlying assets that are within those funds. The funds that we've launched most recently are the property funds. The direct property fund, which looks mainly at commercial property, launched at the end of last year. We're pleased to say we've acquired 3 properties so far in that fund, and we're continuing to work with our property advisors, DTZ, to identify more opportunities. And more recently, we've launched the residential indirect fund. I'm pleased to say that we've made our first commitment to an affordable housing fund here in the UK. But a lot of these funds are at the early stage of their development, whilst capital is being drawn, and we'll start seeing the performance of these come through over time. Happy to take any questions on any of those.
Has anybody got any questions? No, we haven't, so moving on to the next.
Thank you, Chair. I'd like to take this opportunity to give you an update on what we're working on in the RI team and some of the things we're planning over the coming year. So if we move on to slide 21, please. I won't dwell on this slide for too long. That's just a redefinition of how we manage your money and how we do that in a manner that's consistent with our fiduciary responsibility and your fiduciary responsibilities. So if we could move on to slide 22, please. So just a quick reminder of what stewardship means and why we do it. It's obviously a big part of our daily work. So stewardship is the responsible allocation, management and oversight of capital to create long-term value for clients, beneficiaries, leading to sustainable benefits for the economy, the environment and society. And that definition comes from the FRC. And as you know, we're stewardship code members. So stewardship can be broken down into 3 elements: engagement, voting and escalation. And there's our escalation approach there. There's 5 levels, and we work through that during our engagement and stewardship program with the companies in the portfolio that have been identified as priority stewardship targets. So we move on to the next one. And so what benefits does stewardship bring? So protects and enhance shareholder value, and that's the fundamental reason for doing it. We can influence corporate behaviour, so we identify companies in the portfolio that may have controversies. It can contribute to best investor and corporate practices. We can share our view of best practice with the corporates that we invest in. It helps to align with our partner funds' purpose and values, and it enhances trust with stakeholders. We report quite extensively on our engagement activity to stakeholders. And then just to give you an update on some of the engagements that we've been working on. So we can engage directly with companies, and we've been doing that with Shell and Glencore and Barclays recently. We had a meeting with the chairman of Barclays and a meeting with the CEO of Shell to encourage Shell to be more transparent in the terms of the alignment of its capital expenditure plans with their net zero commitments, and also to commit to targets around scope 3 emissions, which they've been reluctant to do. And equally, we've met recently with Barclays to make sure and to get comfort that they are fulfilling their commitments that they made around integrating ESG into their lending decisions, but also how they wind down their funding of new fossil fuel development. We can also engage collaboratively with organisations such as the 30% Club, Climate Action 100 and the Investor Forum. And also we participate in industry bodies such as the Principles of Responsible Investment, LAP, BVCA, and the Investment Association. And we also engage in advocacy through organisations like the IIGCC and FRC, who engage with government on the development of regulation and policy around responsible investment and climate transition. So just to give you a quick example of an engagement that we undertook with DTZ, one of our property managers. Obviously, human rights is one of our core engagement themes, which we identified and agreed with partner funds at the beginning of the year. And we've worked with them to encourage them to adopt the UK stewardship, the UK Modern Slavery Act, and to implement that through all of their properties and their interaction with the construction sector. And we now feel that they have a best-in-class policy and approach to this. So it's important to work with managers on engagement and stewardship, as well as directly with companies. So as you know, we made a commitment at the end of last year to net zero. So a 50% reduction in carbon emissions by, sorry, you're on the right slide, yeah. Achieve a 50% reduction in our carbon emissions by 2030 and net zero by 2050. And we are tracking this, and this is a core part of our engagement plan. So as you can see from the graph there, if you look at the orange line, that's our normalized absolute emissions, so normalized by our AUM. So that measures the carbon intensity of us as an investor. As you can see, that's dropped significantly since our base year 2019. Now, it's important that we look at carbon emissions through a number of different metrics, not just carbon intensity. So if we look at the companies that we currently hold in the portfolio, because they're the companies that we're interested in terms of stewardship, and we model their emissions back to 2019 and track how they've progressed, you can see they've fluctuated, and there are sort of global events such as the invasion of Ukraine and the growth of the companies in the portfolio themselves have meant that absolute emissions have gone up and down again during that period. And that's an illustration of the challenge of achieving net zero. Ultimately, it is an absolute emissions goal, so it's important that we track that. And interestingly enough, you can see our largest financed emissions in the portfolio are the consumers of fossil fuels rather than fossil fuel companies themselves. So you can see 2 cement companies in there, 2 utilities companies, 3 utilities companies. Berkshire Hathaway's basically emissions associated with their ownership of a utilities company in North America. So it's a re-illustration of the point that this transition isn't just going to be about the supply of fossil fuels, it's about the demand of fossil fuels and the whole transition of the global economy. Again, presenting a challenge for us, but something that we're, as investors, committed to participate in that transition. We can also see from that slide that alignment, we take a very strict approach to measuring the alignment of companies. And at the moment, on the metrics that we use, which are the implied temperature rise, the climate transition score of MSCI, and the science-based emissions, science-based targets, there's only 26% of the portfolio that currently meet all 3 of those criteria. So again, an illustration of the challenge ahead. We could move on to the next slide, please. And just give you an update on some of the work we've been doing with our infrastructure managers. So our head of net zero, Ed Baker, has been working with our infrastructure managers to measure their alignment and their progress on the transition and how they have been engaging with the underlying assets in their portfolios. So we can see that 15 out of 18 managers have 2050 targets, 10 out of 18 have 2030 targets, which is a key engagement point for us. And you can see some other highlights there. Renewable energy already accounts for the largest sector allocation within the infrastructure funds. That's 50 to 55%. So I won't read out all of those the statistics, but that's a work in progress at the moment. It's it's approaching completion. And obviously the climate risk monitoring service is another key element of what we do, and we're committed to trying to make sure that every year that improves and enhances and becomes more relevant. We're aware of the limitations of just analysing scope 1 and 2 emissions, so we've worked towards including scope 3 emissions, even though they're estimated at the moment, including the sovereign asset class in that reporting, and including our private markets portfolios, which we are including this year again, based on estimated emissions at the moment, but over time we hope those emissions will transition into fully reported emissions. And by engaging with managers on this, we're hoping to apply that pressure that will encourage them to collect the data from their underlying investment companies. Next slide, please. And this slide just illustrates that point, that the work that we've done on engaging with managers to encourage them to collect data from portfolio companies, but also the estimation approach that we've been using. So we validate all of the estimates that we have against MSCI publicly reported data. And again, in recognition of the fact that we acknowledge that ESG is much more than just climate, we've also introduced our Sustainable Investment Monitoring Service reports this year, which analyses the portfolios through a broader lens of ESG metrics, covering social and governance metrics, as well as more immediate environmental metrics around pollution, etc. And that's available to partner funds if they want to see that. And that's happy to take any questions or at the end.
If you just carry on to the end, please, Patrick.
I think it's over to.
Thank you, Chair. So hopefully that's been a helpful overview, but I want to conclude by looking forward. I want to briefly touch on the strategic outcomes I believe we should focus on. These are strengthening stakeholder relationships, enhancing investment performance, demonstrating value for money. And if we get all of these right, this will lead to increasing assets under stewardship. These outcomes reflect the insights and feedback I've gathered from conversations with the board, partner funds, the team at LGPS Central and stakeholders during my first 100 days. You'll notice we're focusing on strategic outcomes, not just priorities. That's intentional. These outcomes are long-term, meaning that they'll take several years to realise, and they're also measurable, so we can track progress. They're not about the what, but they are about the what, not about the how. This framework is what we'll use to build our strategic business plan and the 2024-25 budget, which you can expect to hear from us soon about. That's all.
All right, thank you very much, Richard. So, have any members got any questions on our responsible investment policy, or it's a fairly extensive presentation there covering all areas? Has anybody got any queries?
Yes, thank you, Chair. It's going back a little bit. It's actually going back to Trevor's presentation, and it's the LGPS Central product development slide of the different products. I was very taken with the last item, which is local investment, and I'm very much in favour of that, although I'm well aware the devil is very much in the detail. But I was very pleased to see that it is sort of potentially being considered. Thank you.
Thanks very much, Thomas. Yeah, any other questions or queries? No? Well, thank you, Richard, and all members of the team for your presentations this morning. Much appreciated. The next item is the date of the next meeting, which will be during spring 2025, and will be determined after this meeting, but it's likely to be February, March 2025. So if we can just finish the live stream of the meeting for a moment, we just hold on, don't rush out. Okay, so